What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Thanks for tuning in to another episode of the CPA Zone. Today, we have a special guest, Jordan McGregor, founder of PropertyCast.io. PropertyCast is a tool for real estate investors to analyze their investments with accuracy, confidence, and ease. You can unlock real estate investment potential and share professional-looking reports that you generate with PropertyCast.io. This would be ideal for someone that's starting out and trying to learn how to analyze deals. It looks to me like you could also build reports to send to investors if you got something bigger going on and have the background in putting deals together. So Jordan, welcome. Thank you for joining us today. If you'd like to give us a bit about your background and what got you into real estate, then we can kind of get a bit more into the PropertyCast software.
Yeah, I appreciate it, Ryan. Thank you so much. I'm excited to be here, and I'm always excited to talk about our software. I've been in, God, I'm 44 now. I've been involved in real estate for a long time. I got into real estate when I was really young, and it was by chance actually. I was 17, turning 18, and my mom and dad had sold a business. And you know what, they didn't sell for a lot of money, but they had a couple of bucks laying around, and my mom was telling me, like, you need to put some money in real estate. I knew nothing about investing. And I think unfortunately it's a sign of the times. Financial literacy isn't something that we teach. And I find people typically learn it from their parents. And my parents were kind of hardworking people, right? Like they were, like your blue collar, they, going into the office every day, didn't have a really strong financial background. And, my mom just, she was a bit of a savvy lady. She's like, you got to get into real estate. And so she lent me some money, and I got into my first, it was a townhouse in a really, really, really bad part of town. And, it was the mortgage that I was paying. It was like $600 a month. It was super cheap,
Okay.
right? Like it was a $60,000 purchase. And then I started renting out bedrooms. And so it was like, at the time I didn't know, but it was house hacking. And I thought, shit, like what a great thing to do. Like, why isn't everybody doing this? And I lived there for a couple of years, and I really, didn't understand what it was I was doing at the time, and probably squandered a lot of the money that I was making on stupid stuff. I always call it the poor man's mentality. It's like, and that is really a mind shift for a lot of people. When I was younger, I used to, count on that money coming in from rent, and I would think about, well, what can I buy with it? And I would buy stupid stuff, like a car, and I would buy, electronics and TVs and just dumb stuff. And it wasn't till I got, I was there for a couple of years, got a little bit older, and actually was hired with a police service. And as I was looking at transitioning, the interviewer had come in, and we were kind of having a chat about real estate. And he's like, well, listen, you're going to be coming to Toronto. It's quite expensive. And I really started to think, well, geez, what am I going to do? How am I going to afford to live there? Because at the time, 20 years ago, it wasn't a lot of money. And so it kind of opened my eyes a bit. And from there, I had just a chance run-in with this old school realtor. And he kind of sat me down, took me under his wing, and he kind of pointed me in the right direction. He told me like the power of real estate, and I didn't understand it when I first met him, and he educated me, right? He told me, the power of leverage and appreciation and recapture, the ability to make money on your tenants, not only providing you the cash flow, but a recapture of your investment, that
Yep.
principal recapture. And it clicked at that moment, and he kind of got me started into buying specific, like, investment related, multifamily property. And
Gotcha.
from there it started to grow. Then I really kind of got the bug. Like, I find in this business, there's a defining moment in every real estate investor's journey where it's like it's that aha moment. And for me, that was it. And I realized quite quickly, within the span of just a year or two, that I was able to force appreciate. Another interesting term in real estate, forcing the
Yeah.
value of a property just by increasing rents. And I was like, oh my God, like this
Yep.
is this is crazy. And so within a short few years, I was able to amass a relatively substantial portfolio. I was in my early 20s at the time, and it kind of started from there. And
Awesome.
I started, focusing a lot on optimization, which I think is a really important part of investing, and growing my portfolio into bigger properties. So getting away from the smaller stuff,
Yep.
ones that you have to qualify for as yourself, and
Yep.
buying bigger properties where the building itself would qualify. And that's what really kind of opened my eyes to it. And from there, 20 years has passed, and 1,000 properties later, I ended up I left the police service and became a full-time commercial realtor. Started
Awesome.
in the residential game, got into commercial, and I absolutely fell in love with it. It was one of the most, critically defining moments in my life, was realizing what I was capable of and what real estate was able to do for me. Not just real estate, but investing in general. You
Sure.
know, doing something to improve my financial literacy. And it led to, I do this for, funds, syndicates, REITs. I consult, I go all over North America now. Companies will bring me in and we help develop financial modeling specifically related to the particular market or the niche of real estate they're in. And that's what led to the software. I'm like, well, I mean, if the big guys, as you know, Ryan, they never lose,
Yeah.
right? You look at these
Yeah,
big
that's true.
companies, they don't lose. And there's a really specific reason for that. And it's how they undertake their valuations. And it's not something the average realtor, or sorry, not the average investor knows, because it's not taught to you. Like you
Right.
see a lot of these people there's a lot of these Facebook groups all over the world, all over North America, and they kind of teach you how to raise capital, kind of what to look for in a detail, but they don't go really deep. And this
Yep.
is where a lot of investors go wrong. And so our software was based on, 10 years of consulting experience with, multi-million or billion-dollar companies.
Gotcha. And how long have you had Property Cast out there? Well, when
Uh,
did you launch it?
just a year. So
A year. Okay.
we launched a beta version. It was
Awesome.
built on a different platform, and that was what we were using really to generate a lot of the feedback from our user base. What do you like?
Gotcha.
What don't you like? What metrics are you finding really valuable? Defects. I mean, as I don't know if you've ever been involved in software. I will tell you,
Yeah.
whoa, it is like one change to a certain component of the software can have a rippling effect down the
Yeah.
road. So, that's when we just launched our brand new software 2 weeks ago. It's brand new.
Okay. Awesome.
And it's built on a completely different language. Um, we brought in actuaries, so from the US and Canada, to really go through our formulas to make sure that everything we're providing to our users is completely accurate.
Awesome.
But I was using, like, when I would go into consult with these larger companies, we were typically Excel based
Okay. Gotcha. Yep.
models, but they were, I mean, they were really complicated, like
Yeah.
really, really complicated. I mean, even for me, like, we would build them, and it was hard to understand, like,
Yeah.
for most people. And so the idea behind this was to bring an institutional product to a retail market, to show people really quickly, like, how you can do an evaluation, and more importantly, how to remove that sentimentality. And I don't know about you, but this happens to me. This happens to all of us. I mean, you have your two types of buyers: your rational and your irrational buyer. And when I can be a bit of an irrational buyer at times, where I just fall in love with something, and I
Yep.
really need to kind of sit back and look at the property objectively, bird's eye view, look at everything. And 99.9% of any calculator or software or Excel out there, with exception of the institutional products, don't let you do that. They only give you a snapshot as to the purchase. So
Yeah.
if I buy the property, what's my cash flow? What's my down payment amount? And most of them won't even look into, your recapture and your appreciation. Some do, some
Yeah.
don't. But then, there's other metrics that you can really, really dive into, but most just give you a snapshot as to the purchase. And so we wanted to kind of back away from that a bit and really look at the true value of the property, not just what you pay for it. Unfortunately, FOMO has hit the real estate market all through North America, and people are significantly overpaying for property. And as we're seeing now, anybody who bought something during COVID, if they were multiple offers, is probably underwater significantly. And so for us, we like to base our values and our projections on true value. And that helps us get really granular when we look into things like, your average or annual rate of return, your internal rate of return. We're able to pick out, risk. And risk is huge in real estate, right? Like, you're buying something, with a private financing, and you're in your mind, the course you took told you doesn't matter what you pay for it, just, borrow money from everybody, buy it, and then, give it a coat of paint, and you can go back to the bank and get more money.
Yeah.
But that's not true.
Yeah,
And so,
exactly.
we really like to look at things objectively. And that was the idea of the software. We can analyze every aspect of real estate investing, virtually every type of real estate product. And the software is designed to tell you, is this a good deal or not? And, what could the impact be down the road, 1, 2, 5, 10, 20, 30 years? And where is your break even point? Where is the point if you're overpaying that you can get your money back? Because if you're into, I mean, look at the delinquency rates right now, Ryan. I'm
Yep.
sure you're seeing it all over North America, the highest we've ever seen.
Yeah.
And people are losing hundreds and hundreds and hundreds of thousands of dollars. And so that can be prevented. And that can be prevented with due diligence and undertaking proper valuations. And I always say that for me, depending on who you talk to, someone, like, the first thing you want to do is you want to find a good deal. But if you don't know how to
Yeah.
evaluate the deal, you're going to be putting yourself into a really precarious position, in my humble opinion.
Yeah, no, you're exactly right. And like you mentioned at the start of the podcast, that financial education is just, it's not taught, at least not in schools. You have to go seek it on your own, or really find somewhere to mentor you. So having a tool like this, or even just resources that can kind of help you obtain that knowledge and know what to look for and get down to those granular levels, that's huge in any type of investment, but especially in real estate. So I think you really got a good product here, and you're really on point with the financial education, just how important that really is to understand your numbers, how to analyze a deal,
Yeah.
so you don't end up one of those people that overpays because you fall in love with a property, you overbid, and then a few years down the road, you're like, now what do I do?
Now what do I do?
Yeah,
Yeah, now what do I do?
exactly.
And that is, I've been there.
Yeah.
And it is really, it's scary, right? Because you're thinking, oh my Lord, I'm coming due. I picked up a private mortgage and I'm coming due for it, but every appraisal I've had on the property is below my purchase, and
Yeah.
I'm going to be in a negative equity position. So where do
Yep.
I find that money? Oh, I'm going to get another private mortgage, and I'm going to pay another 2 or 3% lender fee, and it's funny, you'll see your equity vanish.
Oh yeah.
And that's not a position that anybody really wants to be in. And it's, for me, it's funny. When I was younger, I don't know about you, Ryan, but when I was younger, I was really risky. Like when I first got into
Yeah.
this,
Yeah.
when you have nothing to lose, you don't care.
Right.
And I mean, I think back to some of the deals that I did, which, I mean, were great because they worked, but I mean, it was 50-50 if that was gonna work or not. And that was based on, a little bit of knowledge. And so I think you hit the nail on the head. Learning what you're doing in real estate, is so critically important, but it's so hard to know where to go. It's
Yeah.
so hard to know who to talk to. I mean, you see, and there's a lot of good courses out there, but I mean, it comes at a cost, right? You're looking at
Right.
20, $30,000 a year to be a part of these groups. And that concerns me too, because, you look at some of the heads of these groups, and some of them are very new to real estate, but they're
Right.
phenomenal marketers,
Yep.
so it's like, where do you go? I don't know, like, where did you learn about real estate? I'm curious.
Honestly, I got into real estate from my background as a CPA, as I'm working with some of these folks that were investors or maybe even business owners that had some real estate on the side. I started noticing all the tax advantages and just thought to myself, why am I not taking
Hmm.
advantage of something like this? So that
Hmm.
got me into real estate. I started investing several years ago now, and started out single family homes, then slowly transitioned to more multifamily. Just recently closed on a deal for an assisted living facility.
Oh, nice.
Yeah, someone in our family ended up in one, unfortunately, and that experience got my wife and I thinking, this might be a place to start looking to invest, because you look at the costs and just how they operate. They're
Mhm.
not cheap. You hear specifically for us, it was dementia. And you talk to these doctors, and it's just the rise in the number of dementia cases and people needing the the care when they get older, whether it's dementia related or simply, they're living alone, they can't really take care of themselves. The lifespans are extending, and a lot of people that they get older, they need some help. So the demand in that area, which is just really growing and looks like it's going to continue that course for a while.
Yeah, it's
So
growing
we did,
exponentially. It's interesting. It's so interesting in real estate. There's so many different things you can do.
yeah,
And I mean, you can do assisted living facilities, you can do multifamily apartments, you can do
yep,
institutional, you can do office space, you can do vacation rentals. I mean, there's so many things. And that's I always tell people to find something you like to do in this business. I mean,
yep,
you don't have to while I feel journeys are very similar, you start off in some type of a residential based purchase, single family,
yeah,
usually, then maybe a single family to a conversion to a duplex, then maybe a
yep,
triplex. Like you kind of start getting bigger, bigger, bigger. You don't need to do that. I mean, people always think more is better. And that's the one thing I try and teach people because I deal with a lot of normal buyers too.
yep,
I love what I do. And I always tell people, like, I had a lady in my office the other day and she's like, I want to buy another property. And so the first thing we did was we looked at her current portfolio. And, when I was done conducting the evaluation, I was like, it doesn't make sense for you to buy. You need to optimize.
yeah,
Once you optimize your current property, it was a single family. She was going to turn it into 3 units. So that's what you need to do. Optimize first. Put your eggs into that basket, optimize, improve, stabilize, pull out your funds and then go invest that. When you start spreading yourself too thin and people think I
yeah,
just keep buying, it is one of the biggest, most fundamental mistakes real estate investors make is they think they need to buy more when optimization needs to be top of mind. And
yeah,
you don't need to have 20, 30, 40 properties. I mean, I have some clients that, I have one guy that just bought a 30 unit apartment building and he's like, that's good, man. I'm fine with
yep,
that. I don't need to buy more. Like I wanted to diversify a little bit. He had money into his pension and money in the stocks. And so I just wanted to, it's managed and he doesn't touch it. And I have other clients that, have a couple small properties and they're fine with that. You don't always
yep,
keep buying. And that's where I think people go wrong in this business too. It's like that attraction of buying more and growing more,
yeah,
it's like it becomes all encompassing sometimes. And so sometimes you need to take a step back. But if you can find that passion in this business, doesn't matter what it is, you're going to love what you do. And I always found like the retirement homes and the assisted living, that was always fascinating to me to think about that. Cause I mean, it's service-based industry, right? It's a
yep,
service-based
yeah,
product
exactly.
you're providing. How big is the facility that you guys are working on?
This one's 44 beds. So we're not we didn't pull it together. We actually explored putting together a residential facility near us and then realized very quickly you can't you can't really put together just one to run. You need a full-time administrator,
Hmm.
which they can't, you're not going to get a full-time administrator with one, 10-bedroom home. You need 3 to 5.
Hmm.
So then I actually met another guy who was putting together this deal. So we went in as one of the investors on that group. So it's a 44-bed facility, and they're putting together another one right now. There's another LOI out there,
Hmm.
so it may join that one as well. But
It's exciting.
brand new for me, so we figured, why don't we go in rather than trying to do our own? Let's go in as investors on a few deals first and get to learn the business side of it a little bit better.
But that's a great thing too. You know what?
Yeah,
It's well, I think was it Warren Buffett that said if he could go back and do more things with partners, he would. It would have made
yeah,
him
yeah, yeah,
more wealthy. And it's like we often think we need to do it all of ourselves as well. But I mean, man, if you can leverage the experience of somebody else, it's like young realtors. They come in and
yeah.
guns a blazing and not a clue what to do. But I mean, if you can mentorship, I will is worth its weight in gold. If you can
Oh,
find
absolutely.
who can, ultimately save you a mistake. And I don't know why it is, but I find human beings sometimes the whole premise behind learning the hard way, we seem to have to do that sometimes. But if you are smart enough not to make
Yep.
that mistake, Man, it can speed up your investment journey significantly. Good for you.
Yeah, yeah, it definitely can. I would say that's true for any sort of business that you're in.
Mhm.
Finding someone that's been there and knows the ropes that can help guide you along. The earlier, the better. You get some sort of mentor or coach in
Mhm.
whatever it is you're doing. Uh, like you said, worth its weight in gold.
Yeah, it's fantastic. Now, I have another question for you, Ryan. So
Yep,
your
absolutely.
background as an accountant. So, when we typically talk to, especially young investors, I always say there's six, seven pillars to your investment journey. You have your equity growth, your appreciation, your tax benefits, leveraging, cash flow. From a tax benefit perspective, what do you find works well for new investors? What should they be focused on?
Really, their focus should be more on finding the good deal, the best deal for them, and then keep the tax benefits as a secondary benefit. It's more like the
Yes.
icing on
Yeah.
the cake.
Yeah.
What I find a lot, especially with younger investors, is they hear about all these tax benefits, and that is like their primary focus, and they overlook some of the basics, and whether it's overpaying for a deal or just getting into the wrong property because they think they need this to save money on taxes, and then they find out they're a W-2 employee and they're a high income earner. They can't deduct those losses they were looking for anyway, and now they're in a bad deal. So I
Mhm.
think the first thing is to find a deal that works and then worry about the tax benefits later and allow those to help you compound and grow.
Yeah, that's
So,
smart. That's
yeah.
smart. Yeah. Yeah. I mean, it really depends too. If someone's taking a property in an LLC or their personal name, do you find that there's benefits to both?
Well, from a tax perspective, there's no difference. Single member LLC is disregarded, so the same deductions are there. That LLC does provide legal protections. Certain cases, if you're doing flips, it may make sense to go into an S corporation. That way, you lower your tax liability on the self-employment taxes. But if you own a property in your personal name versus an LLC, from a tax standpoint, you can take the same deductions.
Hmm. Hmm.
It's really that legal protection the LLC offers.
Yeah. Yeah. Understood.
Yep. Well,
Ryan, did
speaking
you?
of, oh, good.
Sorry, go on.
No, I was going to say, speaking of taxes, do you have a favorite tax strategy? That's one of the questions I always like to ask guests that you've used at any time through your career.
Yeah, it's typically depreciation on my assets.
Yep.
I have a few properties that are in my personal name, which from a tax perspective, it can be helpful if it can bring down your overall income, when
Yep.
you're off an expense. But on my larger properties, it's typically from a depreciation perspective. But
Yeah.
I mean, that you can only do that for so long, right?
Yeah.
So
Yeah. Eventually it runs out, but
yeah, it can be challenging. And then, the only other thing that, we're now looking at is as some of our corporations start building more money and, we're paying down the mortgages, it's, now looking at strategies involving insurance, where you can
yeah.
buy an insurance premium through the holdco and then transfer it. And then, it can be done at a complete, it's like tax deductible, right? So
Yeah.
it's,
The captive insurance
yeah. So
policies. Okay. Yep.
yeah, so there's, and that we're just doing that right now with some of our properties. But
Okay. Awesome.
it's definitely something that it's not for the average investor either. I mean, it's,
Yeah.
you get to a point where you're trying to mitigate your liability to the government, but ultimately you can only do that for so long. And it's, that's another thing with, real estate as well. And I think, that they were, was it one of Harris's talking points, was, taxing unrealized gain. And I thought
Oh,
that was
yeah.
really fascinating. That unrealized gain is for, from a real estate perspective is how a lot of people avoid tax, right? They
Yeah.
they
Yep.
have an asset that appreciates in value, and they borrow against that asset repeatedly, essentially deferring that liability to
Yep.
the next generation. I don't know.
Yeah.
I find that I do that as well with a lot of my properties. So it's
Yep.
leveraging the equity in my property, refinancing, pulling it out to buy more as well. So that's
Yeah.
not really I wouldn't say that's a tax strategy, but it kind of is.
Yeah.
It's I
It sort of is. I mean, those when
yeah,
you pull that money out in a
yeah,
refinance, that those funds you're tapping into the equity
yeah.
tax free and then redeploying it, and now you've got a new property
That's right.
with new depreciation.
Yes.
It's a very smart investment strategy. So
Yeah.
I see
Um,
that a lot.
Did you want me to show you our software really quickly,
Yeah,
Ryan?
yeah, absolutely.
I know you
Let
don't
me
want to go over too much, but I thought I would, if you allow me to
absolutely.
share, I'll,
Yeah, I just changed the sharing, so you should be able to share it. Yeah, that'd be. I was actually playing around on it a bit last night, and it looks fantastic.
yeah, so I'll try and just explain it to you here. So it's,
Okay.
can you see my screen fully?
Yes. Yep.
Okay.
We're good.
So the premise behind it is we do have an education portal in part of the system. So it kind of can get you started in real estate, understanding, the do's and don'ts to real estate. But the idea is you come into a main dashboard portal here. This is one of our test accounts.
Okay.
And you can see the recent properties that you've evaluated. And the nice thing is, and did this just pop up here? Did you see that?
Yep.
Okay, so you can create a property really easily in the system, and it will pull right from Google. And so what we try and do is we try and hit you with some information immediately. So there's that immediate response of, oh, I'm getting somewhere in the software. And so the idea here is we can pull a photo, we can get
Nice.
mapping information on the property, and then we can name the investment. Um, Kind of the idea behind that is just so we can differentiate what is in your dashboard. I find a lot of times properties can kind of get mixed together. People don't
Yeah.
name them correctly, and so you kind of really don't know what you're doing here. And so the idea is to actually, I'm not going to show you that property. I want to show you one that's gone through the full gambit
Okay.
of purchase, improvement, and refinance. Let's go with this test account. We'll use this one here. Okay. So when you get started into the software, we've broken this up for this. We have different calculators as well, but this one is designed to analyze your purchase. Then we look at your improvement. Then we look at your sale or refinance. And the reason we kind of break it up into three sections is because your metrics can change. So from purchase to improvement, when you start to deploy more capital into your investment, it's going to have a direct impact on your ROI. And so we want to make
Yep.
sure that we can separate those and you have a clear journey as to where you're going with the property and what's making you money and what's not. And so when we go into the analysis, I mean, this is probably comparable to a lot of people. You're met with your purchase details. This little sidebar here will follow you throughout the entire journey. And the reason, depending on your asset class that you're buying, is your debt service coverage ratio is really important.
Yep.
And so, when you're buying something, that's under 4 units, you yourself, unless you're getting a debt coverage service mortgage, you have to qualify for that. But typically, this is going to have an impact on what you're able to get a financing for. And so we like to have that follow you throughout the entire journey of the property. This is where you just kind of pump in all the details related to your purchase, your rents, any additional incomes. And what I was talking to you about before, so this property is not a good purchase. This is one that I talked to my client about buying. But what we like to do is we like to do an advanced purchase evaluation option in our software so we can
Nice.
really look at, from a granular perspective, what is the true value. I mean, I always say this to investors too. If you are an experienced investor, you can buy based on speculation or potential.
Yep.
Especially if you have a surplus of funds, you're financially stable, and you are incredibly experienced, you can run a property at a deficit. But if you're new to this business, you need to be very careful in doing that. So what we like to do is we like to try and determine a value, and we do that through either an income approach, which would involve like a cap rate based on
Yep.
classification, so A, B, C, D, or a direct comparison approach. So we can do it both ways.
Okay.
The reason we want to do that is because we want to establish what your true equity is when we get into from a liability perspective. So in this situation here, you have a down payment of 150,000. Most people would say, "Oh, well, I have $150,000 in equity," and that's not how it works, right?
Right.
At the end of the day, we still have to consider, if you had to liquidate or sell. So,
Yep.
what is your net value in the property, which is different from equity. But what is your true equity? So in this situation, you're overpaying significantly for the property. And so while for some people, if you're an advanced purchaser, that might be okay. But for the average person, these are things that you need to think of. Okay.
Yep.
What is my true value? And, depending on the market you're in, your whole strategy might be based on force appreciating the property through rent turnover. But if you're in an area that has strict regulations with respect to the rent eviction process, you could be inheriting professional tenants that you can't get out, that you can't
Right.
get. And so buying based on that strategy with a little bit of advice could ruin you financially. And so these are the things that we want to look at. What is your total ROI on purchase? This is where we take into account your cash on cash recapture appreciation. Those three metrics for any investor are incredibly important. Where do you fall in this situation? We're cash flow negative. That's a huge red flag for me. Always,
Yeah.
always, always a huge red flag, unless we have a couple of vacant units. Then we look at our internal rate of return, our average rate of return, or annual rate of return, and our net value, and we can kind of get a bit of an idea of where are we 1 year, 5 years. I mean, even at 5 years, you're still in a negative equity position, which is incredibly dangerous.
Yeah.
So these are the red flags that we want to point out, because we could be in situations here where we see, and I'll just show you. Let's say this rent is, let's say it's $1,400 a month. Just going to change it here quickly. So we look at this and we say, oh, well, I'm cash flow positive. Hey, maybe that's not too bad. I'm breaking even. But when we look at it, we're only a 6-7% average rate of return over 5 years. I mean, you're going to make more money in the S&P 500,
Yep.
right? So these are the things that we need to think about. I'm overpaying for this significantly. Why am I doing this? Where do you make money, right? You make money on the buy, right?
Yeah.
So
Exactly.
we have to think about these things. And, this is why we've designed this, where we can hit you with a lot of information relatively quickly. And it's going to tell you, your time to recapture is 44 months. So I'm going to be underwater on this property for 4 years.
Yeah.
So
Oh, that's awesome.
red flag, right?
Yep.
This will be improving in the next couple of weeks. This is where we're actually going to be able to track your net value contributors, where you can see your down payment, your
Okay.
costs, your improvement costs. But then what we can do and this is, again, we can do a full breakdown here of all your returns, your total profits if you had to sell. I think what the best part about the software is, and I find a lot of people do this, right? When they buy a property, they look at a 10-unit building and the average rent is $1,000 and maybe it could be 1,500. They do their numbers based on fully optimized.
Yeah.
And in my experience, and again, I have quite a bit of it, I've never seen that happen where you're able to fully optimize. So what we've done is we've broken down a tool where you can compare your current rents. And then what you can do is you can strategically isolate what units do you think you can reasonably improve. Okay, what units do you think you can actually improve the value of? And we like to establish a project timeline. This is important too, because I always tell people you need to set or determine what is your stabilization. And we do this with all the big companies, right? So we always, when they're buying an asset and it's underperforming, what we want to do is we want to determine stabilization, because when we want to project numbers to the financial partners, we typically aren't using that stabilization timeline. That stabilization timeline is built into their returns. And so what we want to do is we want to set that timeline. And what I'll do here, and so in this, your current rents, this toggle switch is if you're going to say, hey, this unit's $1,400, but I think I can get it up to $1,600 within a year. It's going to be maybe $15,000 in renos. I got to buy the tenant out. We want to be able to track all these inputs, because these inputs are going to be really important, because the inputs are going to tell you how much money do I need on top of my purchase.
Yeah.
Right. And more importantly, where's the money coming from? And so in this example here, we're going to be identifying, a few units that we think we could turn over, relatively quickly. So I'll pick 2 units. So we're going to say, hey, within 1 year, I think I can turn 2 units over. We're going to establish, any other. So this building, this is actually a real property. It was in really, really bad shape. So the other thing people forget about, Ryan, is capital expense requirement, deferred maintenance.
Yeah.
God, I mean, especially on these older properties, they will kill you. People don't realize that, right?
Yeah, absolutely.
It had 3 different types of roofs. It was the brick was Spalding. There were a lot of issues. So you're looking at 100,000 is light. It was more like 200 grand, but I'll put 150,000 in there. So we can track all of your inputs and when they're required. Okay. The other neat thing we can do is we can actually finance your improvement money. So if you're pulling from a line of credit,
Ah, nice.
finance. And the reason we do that is because it's going to change your ROI. Because if you're borrowing more funds versus using your own, the borrowed fund is going to keep your ROI high, right?
Gotcha.
Now
Yep.
there's going to be a cost to debt service it, but it's going to keep your ROI high. So in this case, I'll just say it's a cash investment, no other income in the property. And then here, what we can do is we can readjust our expenses. And so this is another place where people make money in real estate and they don't realize it is it's improving your expense. So it's not just
Yep.
increasing up your income, it's an increasing your net income. And so if we can improve our income, but also decrease our expense, we're going to grow our net income. And so this is where we look for efficiencies, right? Like if a unit is all inclusive, can we turn that over and have the tenant pay for it? If so, what's the cost? So, we look at the improvements we can make. The system will automatically attempt to revalue the property, kind of like the first part where it's you can do it on a comparison perspective, or you can do it on an income perspective.
Gotcha.
So the system, what it tries to do is it says within a reasonable degree of accuracy, if you do this, your property is going to be worth this.
Nice.
And then what we do is we look at a whole new data set, which is separate from our purchase, and we can see, our total cost, almost $400,000, our new cash flow. Then we can see our equity contributors. So where are we making money? We're losing money on the purchase, but we're making money on our passive equity growth. We're making money in our active equity growth, and we now have a new total equity. But again, this is where investors go wrong, is they over improve. And so in this
Yeah.
situation, you've put in almost $200,000 in renovation, but you've only increased the building by $140,000.
Nice.
This is
Okay.
a huge red flag. So you're saying
Yeah.
my rehab isolated improvement is at a loss. Therefore, I'm putting money into a bad property unless I can really improve the purchase price. And so again, these are the little things that we try and show people that, just because you're able to buy a property doesn't necessarily mean it's going to be the right property for you. And then our metrics change. We can track, isolated ROI, just specifically related to your improvement. And whenever I see something like this,
Oh, yeah. That's awesome.
I run, right? And it's so this is kind of the power of the software, right? Then if you want, you can refinance, you can, put in new loan to value information, and it's really going to tell you, are you going to be ahead? Are you going to be behind? And another feature that we have coming in the next couple of months is going to be an AI rating system where the software
Oh, nice.
intuitively undertake a rating on every step. And so
Okay.
this is where the actuary, and this is what people don't realize, right? Like this is where the actuaries come in, where we build proprietary formulas to actually rate every single step. And so the system will then give you a rating on the property saying good buy, bad buy. And
Gotcha.
it's meant to kind of be that, that little angel on the shoulder to say,
Yeah.
hey, but you might want to think long and hard about this before you actually make this purchase, because it could turn out to be financially disastrous for you. And so,
Gotcha.
and the other real, I'll leave it with this. I don't want to bore you with it, but the other cool thing is we can actually share property. And this
Oh,
is
nice.
something that is, this is a game changer for me. I know I deal with mortgage brokers all over North America, and it's like, when you're trying to get information to somebody, what we typically do is we send, a Microsoft Word document or a PDF that has, the income and some expenses, and typically the expenses are never complete.
Yeah.
And so what we can do in this situation is we can either just create a link and send it, post it on our socials. Let's say we're fundraising and we're trying to find financial partners, or I can input in the email address here. And the cool thing with this is if I input your email address and send it, I can track it. And so what I can do here is I know when you open the link. And more importantly, we have an import feature where you can import all my data. So
Uh,
how great is that, right? So
yeah, that's awesome.
you don't have to copy the work. You just hit a button and it automatically imports all of my work. And therefore, then you can undertake your own evaluation really quickly, where you don't have to repeat the process, right? And so
Gotcha.
our system will be able to track that. And so even from a lead generation perspective, what we're trying to do is, we're trying to create a system where, if you are in a real estate mastermind group and you're looking to generate funds, you can send individual links in and you can tell who has interest. You can see at real
Gotcha.
time as they open it. And that's the thing that is, in my opinion, valuable. And the best part, Ryan, is this is free. Our software is free. you can do everything. So what we've done is we've made the entire purchase component totally free, no cost.
Awesome.
You can share everything. If you want, if you really want to get into the nitty gritty, you want to get into the improvement and refinance. There's an upgrade and it's very minimal. But I want to help people. I'm trying to open people's eyes. And, in my mind, the best way we can do that is give them something that we would normally charge for, which is this, and it's totally free. Take it, use it, make good decisions.
Yeah, that's awesome.
And I think if people can do that, I think it will change their lives if they start making good decisions,
Yep.
and they do it from a place of knowledge. And these will be the things that are the game changers.
Yeah, no, totally agree. Well, that's awesome.
Yeah.
Really appreciate the walkthrough of
Yeah.
the tool as well. That's great.
Yeah, no worries, man.
Awesome.
Yeah.
Well, we are coming up on time. I think just before we go, is there anything that you have exciting new projects in the works coming with the tool? You'd mentioned the AI thing that's
Yeah.
going to rank the deals.
We do. Yeah. Thanks for asking. Yeah. So we are working with another company right now for data collection. So what we're going to be doing is
Okay.
we're going to be building in an API where we can help people all across North America with things like, what should my projected appreciation rate be? What should my projected expense rate be? What should my projected cap rate be if it's applicable?
Oh, nice.
What are the average rents in particular areas? And so what we're going to be doing is we're partnering with this company to start bringing in that raw data. So when our users are trying to forecast what the potential value could be if they can improve units, we're going to be giving them some placeholders, right? So they can say, hey,
That's awesome.
I'm buying a property in Austin, Texas, and it's in this particular neighborhood, and these are the average rents for this building type in this bedroom count. And so, and again, it's not always 100% accurate.
Sure.
An average, it depends on, the fitness and condition. Is it
Yep.
luxury? Is it just affordable? But it's meant to help people make that decision so they're not. So, one of the other killers in real estate right now is that confirmation bias, right? It's like,
Yep.
man, I want this property so bad that I'm going to make the numbers work. And it's like, I can't quite make it work. But if I could get maybe $1,200 a month for this unit and I could
Yeah.
I'll drop my property management to 2%, then it
Yeah.
works. And it's like, that is also a big red flag. And so these are the things
Yeah.
that we want to help people on too, is where we can show you the numbers. Here they are. These are the numbers. These are the averages. This is what your market's supporting. And the other really cool thing, we have quite a few clients who buy big portfolios. And so what we're bringing in is the ability to actually just take a picture of a rent roll
Oh,
or upload
nice.
it, and it will automatically populate your
Oh, that's awesome.
it will automatically populate. Oh, sorry, Mike, I'm not sharing my screen, but it will populate the income section, because that can be very time consuming, right? Like when
Yeah,
you're,
exactly.
I did a 200 unit building the other day. It took me 2 hours.
Yeah.
And it's like, so what we want to do is, you can put in a gross total, but
Yep.
I like to break the units down individually so I can really get granular on the forecasting future value.
Sure.
Right? When I
Yep.
can pick what units I think I can reasonably turn over. And so this new feature, we're testing it right now. I mean, it's a lot of work, right? But what we're trying to do is get it so you can upload a rent roll. It automatically
Boom.
pre-populates your purchase section, and you can analyze, a 100 unit apartment building in 2 minutes.
That's awesome.
And so
Yeah.
that is coming as well. It's meant to be, and even with, we are going to be making tweaks as well. So I do a lot of development. So I like to build buildings now. Not
Okay.
all things, like I'll build triplexes. We have a 50 unit right now that's starting, but building tools that can help people forecast development as well. So that's another feature that we're going to be bringing out next year, is
Okay.
development component. And then we also have a fix, flip, and wholesale component to this as well, where if you're just doing
Cool.
fixes and flips and wholesales,
Yep.
that software can help you determine value on that as well. So we're trying to be all encompassing, but at the end of the day, jack of all trades, master of none. Our real focus is on investment related property and determining where determining your key metrics.
Gotcha.
Yeah.
Well, that sounds awesome. Looking forward to seeing some of those roll out soon.
Yeah.
I guess before we go, is there a best place that people can get in touch with you other than the website? The website's
Yeah.
propertycast.io. I'll put all that in the show
Official
notes.
official Jordan McGregor is my Instagram handle. Otherwise, I'm very Googleable. You can Google me and you can probably find my
Awesome.
number. I'm probably one of few founders. Like I do a lot of the onboarding. I do it all myself, right?
Awesome.
I'm so passionate about this. So if people are interested, even if they just go to the PropertyCast website, they can either book in with one of our
Oh
webinars, or
yeah.
even book a one-on-one with me. And
Okay, awesome.
I actually spent a lot of my time, which is probably counterintuitive and cost prohibitive, but a lot of my time I talk to people all over the world. Actually, it's kind of fun, and I spend 30
Awesome.
minutes, 40 minutes with them, and we go through the software together. So I'm happy to do that too.
Awesome. Good deal.
Yeah.
Well, I appreciate your time. It's been great talking to you and learning more
All
about
right.
PropertyCast. So have a good one. And
I had
thanks
a
to
pleasure,
everyone for
Ryan.
listening. All
Take
right,
care.
till next time. Have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.